Sorry, I was just trying to see whether I can get that chat installed again, but with the meeting ongoing, can't do it. And there are a couple of meetings happening as well. Right. So we start on equity markets, right? Before equity markets, just on the question that was asked on short selling, whether you had to put it, whether you had to identify it as a short sell. Yes, you have to identify it as short sell. Are you here at the moment?
Yes, Vinay.
Okay, thanks. Yeah. So you have to identify it as a short sell at the ATS level, at the bid level itself. That's what it says.
Okay.
And you can't do short selling online trade for online trades. It has to go through the broker.
Right. Thank you.
So equity markets one by one, I'm not going to go through all the slides, right? I'll concentrate a little bit more on a few slides. And we'll jump through because a lot of these things you will know. So I'll just, on most slides, I will try to jump through the sections, right? I mean, you have to understand that when we talk about shares, you're talking about ownership, right? That's the important thing to understand here. When we say we are buying shares of a company, we are essentially becoming owners to that company. That's something that sometimes doesn't strike us, just like when we buy a debenture, or a commercial paper or securitized paper. We buy a piece of paper, it doesn't, we don't understand that we are becoming a creditor to the company, right? Similarly, when we buy shares of a company, we are becoming owners of a company. And as legal owners of a company, we have what we call residual claim. Residual claim. What does residual claim means? It simply means that the assets that remain, that are residual, after everybody else has laid claim on it, right? So this is important in bankruptcy. In case the company goes bankrupt, the company that we have invested in, we are owners in, goes bankrupt, then what we have is what we call residual claim, meaning after we have paid all the creditors, the secured creditors, the unsecured creditors, the subordinated creditors, right? All those different creditors, we have paid the preferred shareholders. After we have paid everybody that needs to be paid, if there is anything else remaining only, we can take back, right? So when we say a company goes bankrupt, most of the time there is no way for us to recover our money if we remain shareholders, because for a company to go bankrupt, obviously it's because the company is not doing well. And if the company is not doing well and they don't have enough assets to pay back its creditors, it's highly unlikely that there will be enough money to pay back the shareholders. But if there is, we have residual claim. As shareholders, we have residual claim on it. So as shareholders, there are voting rights that you have. But of course, you can become shareholders to non-voting shares as well. If you become a shareholder to non-voting shares, then that simply means that you have no voting rights. But you can participate in the profitability of the company, such as dividends. Okay. Preferred shares and common ordinary shares, right? The difference between preferred shares is that preferred shares essentially has a preferential, or you get paid as dividend before everybody else, right? You're a shareholder of the company. That doesn't change. It's a hybrid security. It's a hybrid security to the extent that it has features that look like debt and it has features that look like shares. We call it a preferred share. It is essentially a share, but it has, depending on how it is structured, it can have features that are more debt-like or it can be more share-like, right? What does this mean? In a preferred share, you have what we call, so there is an identified dividend, right? So if you invest in a preferred share, for example, the dividend, it might say dividend of 10%, for example. So that means for every 10 rupees that you spend, you get a 1 rupee dividend. You're promised a 1 rupee dividend to be paid. Okay. So no matter what happens, whether the other shareholders get paid dividends or not, you get paid that 1 rupee dividend. So it is like, you can see, a debt security, because you get paid a 1 rupee dividend. What is that? That is like on a 100 rupee face value, you get paid 10%, 10 rupees, right? So what are your cash flows looking like? You get 10 rupees forever, right? As long as the preferred share exists. And sometimes these preferred shares can be short term. They can be what we call redeemable shares, meaning they have a specific life. Then they are more like debt securities, because the preferred share, and what is the, other than the ownership rights, okay, what is the difference between a preferred share and a debenture that has a 100 rupee par value and pays 10%, okay, and has a 5-year redemption? It's redeemable in 5 years. A debenture has a 5-year life. It's redeemable in 5 years. So does this. Okay. The difference is the order in terms of bankruptcy where you fall. Debenture holders versus shareholders, right? Ownership rights. All of that is there. But you can see here, if you are looking at a redeemable preferred share, your security is more debt-like than an irredeemable or non-redeemable preferred share. You can cumulative versus non-cumulative preferred shares mean that to be able to pay this 10 rupees or whatever, 10% that has been promised to you as a dividend on your share, you need to have certain reserves, right? So, I mean, there are certain tests that you should be able to pay. You should be, in terms of cash buffers and all that, you would check and you would see whether you can pay this or not. If you can't pay your dividend this year because you don't have enough cash reserves or you don't have enough reserves, you can have the option to pay both dividends next year. So if you miss out on a dividend this year, it can accumulate to next year's dividend, right? So this year it's 0, but next year, instead of getting 10 rupees, you get 20 rupees, right? You are owed 20 rupees. This is what we call cumulative preferred shares. Non-cumulative preferred shares mean if you don't meet the requirements and you can't pay that year's dividend, you will not get. But next year, you will get your dividends as usual. It's non-cumulative, right? So this year it's 0, next year it's 10, and the year after it's 10, depending on whether the dividend can be paid or not, right? So you can see if it's cumulative, it's more like a debt, because every single payment that is promised to you, you will get. Only thing is timing will differ. If it's non-cumulative, it's more like equity, because if you have profits only, you will pay. Otherwise, it's 0. Sometimes this is not a phenomena that you see often. Your preferred shares can be defined as participating or non-participating preferred shares. Most of the time, the most common type of preferred shares are non-participating preferred shares, meaning they promise a certain return to you, and that's the return that you get, right? Participating means participating in profitability of the company, right? Remember, I spoke to you all those days when we did the debt section. We spoke about how, as a creditor of the company, you don't get to participate in the profitability of the company. Then we spoke about how, as a creditor, if you're promised that 10% return, you will get 10%. But that's why, we spoke about this in convertible debentures. And that's why with the shareholder, if the company does really well, they can get higher dividends. If the company doesn't do well, though, they might not get dividends and they might make capital losses. Versus as a creditor, you have that guarantee until the company goes bankrupt or defaults and can't pay, that you're going to get that 10% return. Right? So participating means being able to participate in the profitability of the company. So in participating preferred shares, which are very rare actually, you can have something like, for example, a 5% return plus a variable component, for example, right? You can have a variable component to your return. In which case, this looks more like a share versus non-participating means there is a guaranteed return to you. So in which case you are non-participating, your return doesn't depend on the profitability of the company. As long as the company makes profits, you are able to get your return. Right? So that's non-participating preferred shares, in which case it looks more like debt. So preferred shares are senior to common shares, right? Ordinary shares, because they rank above ordinary shares. So in the ranking, in terms of default or bankruptcy, you pay back your creditors, you pay back your preferred shareholders, and then only you look at the residual claim for your ordinary shareholders. And they generally don't have voting rights. Okay. So we spoke about primary markets and secondary markets. The only thing, remember, primary markets are where new securities are sold, right? Essentially, this is where money is raised. New securities are sold. Remember, primary market can be offer for sale or offer for subscription. It doesn't mean that brand new securities doesn't mean that somebody might be raising money for themselves, but it's a primary market. It's the first time the securities are sold to the public, right? So primary market where new securities are sold. And why we have primary markets or why primary markets are important is this is how companies raise money or people raise money. So it's a way to channel funds from haves to have nots. So those who essentially from savers to borrowers. And in primary markets, we talk about IPOs, spoken about IPOs before, and also seasoned public offerings, seasoned equity offerings, SPOs or SEOs, seasoned equity offerings. Right. What it means is just like an IPO, you can have seasoned public offerings as well. This is where the company will do a secondary offering of shares. Okay. Secondary offering of shares. So IPO is the first time shares are offered to the public of a company or an investor. And in SPO, a season offering, the company is already now offered to the public trading in the market. And now you offer shares again to the public to invest in. This we call a secondary equity offering or a secondary public offering. What's an example? What's a very common example of SPO or SEO? Where shares are offered, where new shares are offered to the public to invest in, and the company raises money by doing this, but it's not an IPO.
Rights issue.
Rights issue, yes. Rights issue is where companies are raising money again. Now, Commercial Bank has announced a rights issue, right? And what is it doing? It is raising money again by offering new shares. Here, the public is in a rights issue. It's a defined public because it's to existing shareholders, right? In a rights issue, the public is defined. It is the existing shareholders of the company. But so rights issue is a good example of a secondary equity offering, right? But you can have a secondary public offering or a seasoned public offering, SPO, where you offer new shares to the public and it is not necessarily your existing shareholders. In the rights issue, you offer new shares, you raise money to the company who is already listed but you offer the shares first right of refusal to the existing shareholders. In an SPO, you offer new shares to the public. Company is already listed. They've already gone through the IPO. They are already listed in the market. Shares are trading. You can separately do not a rights issue, but an SPO, where you offer shares to anybody to come and invest in the company. Now, Sri Lanka has had one SPO so far, SVB Bank. Right? They did a SPO a couple of years back, maybe 2022 or so, where they offered shares to the public, new shares for them to come and invest. You can see here prospectus, secondary public offering, 2021. So Sanisar already is a company that was listed in the market, right? So they were already in the market, they were trading in the market, and in 2021 they decided they want to raise new money, more funds for the company instead of doing a rights issue where they want to raise that money, or they try to raise that money through existing shareholders. They said no, they will offer it to everybody. So they did a issue, a secondary public offering, right? $68 million new ordinary voting shares, first up to 20 million, and then a green shoe option for an additional number of shares. So 68 plus 20. 68 initial issue and then 20 to make a total of 88 million. Yeah. And this is their secondary public offering. So what's the difference between a rights issue and a secondary public offering? Is that in a rights issue, you offer it to the existing shareholders. In a secondary public offering, you offer it to all public, right? It's an offer that is open to all public, just like an IPO, but it is done by a company that's already carried out the first issue of shares and is already trading in the market. Secondary market, I mean, that's the primary market, right? Where you raise money. The secondary market is where you trade. And why is the secondary market important? And that's the most important thing. Why do we need secondary markets, and why is the secondary market important? Not just to provide liquidity. It is important to provide liquidity, but it is also to provide price discovery. Price discovery. Price discovery is where you help determine market prices. Where you help without price discovery, Sanasa wouldn't know, for example, at what price to come for its secondary public offering. Commercial bank, if your price discovery, if your secondary market isn't active and liquid, right, then you will see that your prices are either depressed or not trading well. Right now, in a bad market where you have a bad secondary market where your share is not trading or not trading well, then what will happen? Let's say your share prices are depressed because you have a bad secondary market. Right? If this is the case, then what will happen? You will have to do your rights issues are usually given at a discount, right? You're trying to entice your existing shareholders to put more money into the company. So rights issues are generally given at a discount. So on a bad price, you have to offer further discounts. So which is where good secondary markets come into play, because price discovery is where you will now know what is the proper price for this company, what is the price that I should offer new shareholders to come and invest in this company, right? All of these will come because if we have good secondary markets. And even when we want to do a new IPO, right, we will look at what are the other companies in the market trading at, for example, right? And then we look at, okay, we have a new IPO coming. And based on the other companies that are trading in the market, we will look at what is the proxy price that this company is worth. So these are things that we will look at in terms of secondary market. This is why secondary markets become important. So a good market is where you have liquidity, you have availability of timely and accurate information, right? Because you want to be able to act on that information, and you want to be able to, obviously every single person wants to be able to act on the information first. But the information that you're acting on should be accurate, and it should come to you fast. Then it depends on how fast you act on that information. But if the information comes to you too late and somebody else already has that information, right, and they've acted on it, you would lose out. So the information has to come to everybody or in a timely and accurate manner. There has to be liquidity in the market. Liquidity means you're able to sell quickly. Remember two things, and at the right price, at a price close to the prevailing market price or at the price close to the accurate price, right? Price continuity. You don't want markets where from one trade to the next, the prices jump at high levels, right? So where stock is very illiquid, you will see one trade has been done at 99, then the second trade happens at, let's say, 120, then another trade happens at 80, right? And you have these, like, ideally, you would want a market where trading happens at very close price intervals. So there is price continuity. There should be breadth in the market, breadth. Right? Meaning there should be a larger number of stocks in the market, and there should be depth in the market, meaning there should be a large number of buy-sell orders in the market, okay, for each share. Depth in the market is about, breadth in the market is about how many shares you have, right? Now in Sri Lanka, we have 284 shares in our market. It's a small market. You will have other markets that will have 5 shares in their markets, not enough breadth. Because with 5 shares in the market, what are you trading? What are you buying? What are you selling, right? It will probably be held by a few big investors. It's not really a market. So the more shares you have, then only you have better accessibility to a wider variety of different companies and investment opportunities, right? So that's breadth is important, and so is depth. Just because you have companies, if the companies are not trading, it's not good enough. There should be depth. There should be a large number of people interested in buying and selling these companies. So the presence of many buy-sell orders around the current market price. If the current market price is 100, I don't want the next person who's selling it to want to sell it at 120, right? If the next person who's buying it is willing to buy it at 80, that's not good enough. So there should be a lot of buy-sell orders, and it should be concentrated around the current market price. Transaction costs should be low. And transaction costs are two different things. You have direct transaction costs. Direct transaction costs are essentially the transaction costs that you see, right? For example, when I buy or sell a share, I know I have to pay 1.12% for transactions below 100 million, 1.12%, right? That's my direct transaction cost. Every time I buy a share or sell a share, I have to pay 1.12% on that share price. Okay. My indirect transaction costs are things like what we were talking about above. Is there depth in the market? Is there, when I buy a share now, what is the bid-ask spread? What is the difference between the buying price and the selling price? What is the bid-ask spread, right? The buying price and the selling price. Okay. So, like for example, in my example that I was talking about, if somebody is willing to sell at 120 and somebody is willing to buy at 80, That's not an efficient market, right? The transaction costs are very high. So if I buy at 80, I have to wait a lot before I am able to sell the share again. So those are my indirect transaction costs. Yeah. And my market should be efficient. So we talk about information and efficiency when we talk about um, um, market efficiency, right? So we have a separate chapter on market efficiency, efficient market hypothesis, EMH, and so on. So we talk more on that, but our market should be informationally efficient, meaning, like I said right at the beginning, the information should pass on in a timely and accurate manner and fast. And the prices of the shares should adjust to that information very fast. And this is not just true for shares, of stocks, of bonds, of um, derivatives, of foreign exchange, any security that you can think of. The price adjustment should be fast. Okay. Right. We'll come to rights issues. Now, we spoke a little bit about rights issues, right? But the thing that I want to talk about here when we talk about rights issues, now, we said that rights issues are essentially an invitation by the company trying to raise money, and they're asking existing shareholders to purchase additional shares of the company. Existing shareholders to purchase additional shares of the company, right? So usually rights issued are offered at a discount. So a couple of things that I want to highlight in this rights issue component is, how do you calculate the discount? What is the discount offered in the rights issue? And when a rights issue happens, what are the things you as a shareholder should take into account, and what are the things you should do? Right? Now, as a shareholder, you have options in the rights issue. It's not just subscribe for the rights or not subscribe for the rights. You have three options. So when a rights issue is offered, imagine you have the shares. So commercial bank is doing a rights issue right now, right? So commercial rights issue, excuse me, commercial is doing a rights issue right now. And imagine you all are all existing commercial bank shareholders, right? Commercial is coming with a rights issue and they're saying that they want to raise money and they're offering new shares to its existing shareholders at a certain price. Okay. Let's look at that. So here you have the commercial bank rights issue, right? You can see here, commercial is trying to issue 252 million voting shares and 15 million non-voting shares at a proportion of 1:5, right? So 1 for every 5 existing shares, 1 new share for every 5 existing shares. 1:5, right? For which it's a rights issue. They're trying to raise money. They want you to pay 85 rupees. They're asking you to subscribe for the issue and pay 85 rupees for every voting share and 69 rupees for every non-voting share. Okay. And they have the purpose of the rights issue and so on. Okay. Now, this is what has been offered to you. Currently, commercial share price is 108. 108. Okay. You as an investor should be evaluating what is the discount offered by this rights issue, and is that discount good or bad? Is this something that I want to invest in? Is this something that I want to invest in? What are my options in this rights issue? What are the things that I can do? So the first thing that you can do as an investor, obviously, you can invest. So for every share you have to pay to buy an additional. So for every 5 shares that you have, right? For every 5 shares that you have to pay an additional 85 rupees to buy a new share. You will buy a new share with paying 85 rupees a share, or if it's non-voting, 69 rupees a share. Okay. So that's one thing. Um, okay. Excuse me. That's the first thing that you can. So you can decide to subscribe for the rights issue. That's one thing that you can do. Second thing that you can do is you can decide not to subscribe for the rights issue. What are your repercussions if you decide not to subscribe for the rights issue? Now, you all are existing shareholders of this company. This company has put out an announcement saying that it's going to do a rights issue, right? You decide, okay, I have, let's say, 500 shares, okay, or 500 shares or 5,000 shares. So for every 5 shares that I have, I can buy one new share, meaning I can buy 1,000 new shares. 1,000 new shares means I have to spend 85,000 rupees. I don't have 85,000 rupees to spend right now. So I'm not going to exercise my rights. What is the repercussion to you if you don't exercise the rights issue? You don't exercise your right to buy? That's right. You will dilute your ownership. So earlier, if you were 1% shareholder, I mean, if commercial with the number of shares out there, you would be much less for 5,000 shares, right? But earlier, if you were a 1% ownership of the company, now the company is getting more shares and you're not applying. So therefore, because you're not applying, your ownership will come down. Okay. So not applying is really out of the question. It's not something that you should do just as a point of don't apply and don't look at it, right? Because you've been given some shares, you have been pre-allocated some shares, and they're saying if you want to, you have the right to buy it. And if you pay me 85 rupees, I can give you these shares at 85 rupees. Right now, my price is 108 rupees. So I look at it, I'm evaluating it. The first thing I evaluate is I have 5,000 shares. For every 5 shares, I can get one new share. That means I can get 1,000 new shares at 85 rupees. Right. So 1,000 new shares at 85 rupees. So earlier, if we just put some random numbers and say there's, let's say 50 million shares at commercial, I'm just putting random numbers now, right? 10 million new shares are going to be issued, correct? 5. So earlier, let's say I have 5 million shares currently. That means in this scenario, I am a 10% owner of commercial. Okay. I'm a 10% owner of this bank. I have the right to buy 1 million new shares at 85. If I buy it, commercial has 60 million new shares at the end of the rights issue, and I have 6 million shares. That means I remain a 10% owner if I subscribe for the rights issue in full. If I subscribe for the rights issue in full, I remain, my percentage does not get diluted. But I have to spend for that. But commercial prices are 108. I'm spending 85. We'll talk about the discount later on, but I'm spending 85. So I'm spending a lower amount buying these shares than I would have if I bought commercial bank share directly. So that is there. And I subscribe and I'm still a 10% holder. That's fine. If I ignore my rights, if I say, okay, but to do this, I have to spend 1 million into 85 million more to buy these new shares. I don't have 85 million rupees right now. I can't afford to buy these new shares and I ignore my rights. I ignore it. I don't do anything else. I ignore it. Then commercial after the rights issue will have 60 million shares, right? I will have 5 million shares because I have not done anything with my rights. Now what will happen? I will be an 8% shareholder of commercial, not a 10%. 8% shareholder of commercial, not a 10% shareholder of commercial. I will dilute myself. If I choose to do nothing, I will dilute myself. And you should remember, after the rights issue, we have more shares in the market. So the market price is going to come down. Right now, the market price is 108. But this market price is going to come down below 108, right? Because there are now 60 million shares in the market versus 50 million shares originally. So now my 5 million shares are going to be worth less. Let's say the price comes down to 100. Earlier, my 5 million shares, just to make my calculations easy, let's say commercial bank price right now is 110. Earlier, my 5 million shares was worth 110 each, right? 550 million. Now, my 5 million shares will be worth 100 each, 500 million. So I'm going to lose out on that way as well. My earnings come down, my holdings come down, and the value of my shares come down as well. So ignoring your rights is not a good thing. You can choose not to subscribe for the rights issue. That's okay. But you shouldn't ignore your rights. You should try to sell it. Sell it to somebody else. Now, what does this mean? This is a very intricate concept. Some of you will be familiar with. Some of you will find it, a lot of the time I see a lot of people find it a little difficult to gauge. You are given a right. A right is not a share. A right is a separate security. Yes. You are given a right to buy a share. And that is a security of its own. That right is a security of its own. Okay. What does it do? The right gives you the right or the ability to buy a share at 85 rupees. So this right is a separately tradable instrument. So we have what we call rights trading. So during this period where you have time to apply for the commercial shares, commercial gives you a small opportunity, a window of opportunity where the stock exchange essentially gives you a window of opportunity where you can trade your rights and sell it off if you don't want to invest. If you think that you can't subscribe for the issue and you want to sell off your right, stock exchange gives you the opportunity to do that. They open up a window where they allow these rights to be traded. Remember, the right is an instrument of its own. It is not a share. It gives the person the right, the person who buys that right, it gives them the ability to buy a commercial bank share at 85 rupees. Right? And stock exchange will give investors the opportunity to trade their rights. So this is mainly to give investors the ability. Anybody who doesn't want to subscribe for the issue, if they don't subscribe for the issue, they are going to get diluted. Not just are they going to get diluted in share ownership, they're going to get diluted in price because the price is going to come down and the value of their investments are going to come down. So therefore, stock exchange gives the opportunity, a trading window, which allows you to trade the instrument called a right. And when you trade that instrument called a right, what are you doing? You're saying, I have the right to buy commercial bank shares at 85 rupees as an existing shareholder, but I don't want that right. If you want to buy it from me and you want to buy more commercial bank shares, I'll sell it to you. So you sell the right. You can sell that right to somebody else. And when you sell that right to somebody else, you have 1 million rights that get allocated to you, right? Because for every 5 shares, 1 million new shares will be issued. As an existing shareholder, you will get first 1 million rights allocated to you. If you decide to subscribe, you will exercise those rights and you will be issued 1 million new shares. But if you don't decide to subscribe, then those 1 million rights are still with you until the final date of subscription. Until the day that you decide not to subscribe and the commercial bank says, after this day, we are not accepting any money. You have to make a decision by this day. This is the last day for you to pay. Until that day, the rights belong to you. Right? So the stock exchange will give you the opportunity to sell those rights. So now you can sell the rights and earn something that will compensate you for the fact that your share price is going to dilute from its current 110, because new shares are going to come to the market and your shares are going to increase from 50 million to 60 million and your share price is going to come down. That difference you can earn by selling your rights in the market. So keep that in mind and try the next question. What is the discount offered in this situation? Also, the discount should be in percentage terms. Okay. What is the discount offered in this situation? Yeah, guys. Discount offer is pretty easy. What is the question here? What is the problem here? What's the question? What is the discount offered on the rights issue?
46.2.
Say that again. How much?
46.4.
percent, is it?
Yes.
Let me just check. No, that's not the discount. Any other answers? So we have one answer. That's in percentage terms. In absolute terms or percentage terms, you can let me know what you think the discount is, 46.4%. Other answers? There is a small mistake in this, so this is not the answer. Okay, it's a good first attempt, right? The 46.4 is a good first attempt. Where is the mistake coming from, or at least how did you get the 46.4? Can you explain to the others?
No, I just took a very simple straight away calculation 5.6 minus 3 divided by 5.6.
Yes. So 5.6 minus 3 divided by 5.6, the assumption here is that you have the current share price is 5.6. You're giving the investors a discount of, the shares at 3 rupees. So the discount is 5.6 minus 3. As a percentage, you divide it by 5.6. But that is not the discount. The discount that you're offering investors is not 5.6 minus 3. Any other answers there or any other guesses as to why it is not 5.6 minus 3?
Do you have to weight it to the ratio?
Why? To the ratio in the sense, it's not weighted to the ratio, but you do have to make an adjustment. Okay. Yeah. And that's correct. Yes. Because the rationale is here, your share price today is 5.6, right? This 5.6 is for a company that has 10 shares. We don't know what the total number of shares is. It's not given here, right? It says issuing 10 million shares. So then from that, you can back calculate what the existing original amount of shares is. But that's not relevant for me. For every 10 shares, you're saying your price is 5.6. You're essentially saying this company is worth 5.6, right? And this is for X number of shares. So if I see, it says by issuing 10 million shares, right? 10 million shares is the 3 new shares. So then how many shares was there originally? How much are the original shares? 43 million. Okay. So issuing 10 shares represent 3 million shares, right? Or 3 new shares. Isn't it 33 million? 43 million is after everything, right?
That's the
33.
3.
Yeah. Originally, you have 33 million shares. Okay. And then you're going to issue 10 million new shares. So then in total, you're going to have now 43 million shares post issue. Post the rights issue. Okay. Today, this 560 is for 33.3 million shares. But what's important to me as a shareholder is the fact that I should never look at, it's a common mistake that a lot of us make. We shouldn't look at the current market price and make a decision on whether to invest in this, right? Is the discount given good enough? No. We should look at how much will this market price go down to post the rights issue, and then look at what is the discount. Otherwise, it looks like a big discount. It can look like a huge discount, but post the rights issue, you should understand 560 is not going to be the price that the share is going to be trading at. Assuming no other information comes and assuming that the share price is 560 today is going to be the same, you should recalculate the share price after the rights issue. How much is this going to be? How much is this going to be? Based on that share price only, you should be looking at what is the discount that is going to be offered or that is being offered to the investors post the rights issue. Or you're making the decision today whether to invest in the rights or not, but you're making the decision based on a price that is going to happen. That should be the way that you make that decision, because 560 is the inflated price based on a lower number of shares. Now new shares are going to come into the market, and the company for every share is going to raise 3 rupees each. So you have to calculate what is that price, how much is this company worth post the rights. And then only you should look at whether you should be applying for this rights issue or not. What is the discount offered? Try it again. Excuse me for a minute. Sorry. So what do you get now? New thoughts? What is the discount offered on the rights issue actually? Go ahead. New. From the derived price.
So is it 30.36?
No. 40%. 40% is, yeah, that's correct. So how do you get 40%? Mhm. Five. Okay. So if you look at the market capitalization is for 33.3 million rupees right now. The share has a market capitalization of 5.6 per share into 33.3 million shares, right? So this is not the exact value, but 5.6 into 33.3 million comes to 186.5 million market capitalization. Then 10 million shares are going to be issued, and for that the company is going to collect money at 3 million each. So the company's value is going to go up by 30 million rupees. Okay. If this is wrong, tell me. So 216.5 million, roughly. Right. This is going to be for a new company with 43 million shares. That means the per share value is going to be divided by 43, 5 rupees. So this is the new share value of the diluted of the company that has now raised more money. Okay. This company has raised at 3 rupees each new money, but it has now more shares. So the diluted share price is going to be 5 rupees. We call this the theoretical X rights price. X rights price. Okay. What that means is this is a theoretical price. It's not an actual price. Because right now the actual share price is 560. In theory, it should be 5. So it's a theoretical price after after the rights come to the market. Okay. The theoretical price after the rights come to the market. Theoretical X rights price is 5 rupees. So my share price, I expect, if no other new information comes, after the rights come into the market, will come down to 5 rupees. So this is my important price. 560 is not a price that's going to be there. Okay. So 560 is not a relevant price to me for me to do my evaluations. The price that's going to be prevailing in the market with no other information available, the price that's going to be prevailing in the market after the rights issue is 5 rupees. My share is going to be trading at 5 rupees. Why? Because my company is going to be worth 30 million more now with the new money that it's going to collect. So with the higher number of shares, that means my company is going to be worth 5 rupees per share. And this is what I should look at for 5 rupees per share. What's the discount that is offered? The discount is actually 2 rupees a share, not 2.6 rupees a share, not 2 rupees 60 a share. Do you understand? Earlier, you all looked at the discount, 560 versus 3 at 2.6 rupees a share. It is not. The discount is 5 rupees versus 3 rupees a share. It is 2 rupees a share. On percentage terms, it is a discount of 40%. Why is 40% important for me to figure out the discount? Why is 40% important? Because I'm trying to see whether it's a good discount or not. If somebody offers me, I mean, it's perception, right? It's up to you to figure out whether this discount is good or not. But if somebody tells me this company is coming at a 40% discount to its current market price, although the current market price is not 560, right? Current market price is my theoretical ex-rights price. At a 40% discount to my term, my theoretical ex-rights price, I would think that's a good rights issue because I have the ability to buy the share at a 40% discount to the current market, to the theoretical ex-rights price, what the price would be trading at in the future with no further new information available. Versus in your earlier analysis, it showed a 46% price. Now, you might think, okay, there's no big difference, but let me show you. Let's see. Let's see if I can show you. Let's say current market price is 560. Okay. Let's assume my extreme example, 1:1 rights issue. For every one share, one new share is going to be issued, right? So at 3 rupees each. Now, when I look at this, when I just look at this, it tells me, if I do this analysis, it looks like I have a 46% discount on this rights issue. How do I get that? 560. It looks like, okay. If I did my calculations without considering the dilution factor, it looks like there is a 2 rupees 60 cents discount or a 5 rupees 60 cents market value to give me a 46% upside. But really speaking, my shares are going to get diluted. I'm going to buy the share at 3 rupees, but my shares are going to get diluted, right? So if I look at what the share price is going to be at the end of this exercise from 560 for every one share, the company will get one more share at 3 rupees. At the end of the exercise, the company will have 2 shares, right? So 560 plus 3 is 860. 860 divided by 2 is 430. 430 is going to be the market price after the rights. Because there's one new additional share for every share. If there are 100 million shares, now there'll be 200 million shares. One new additional share for every share that is there. So the market price is going to fall down. If my calculations are wrong, tell me. My market price is going to fall down to 430. Do you see from 430, what does that discount look like? 430 minus 3. That means my discount is actually how much? 130. 130 divided by 430 is how much?
13.23. 30.23.
30.23. 30.23. So it's not a 46% discount. It's actually a 30% discount. Depending on the number of new shares issued, this discount will keep on coming down. Okay. So at one point, depending on the price differential and the new shares issued, there won't even be a discount. And that has happened in our markets, right? You might think that the price, it's a 10% discount. It's a 10% discount, but it's actually not. How can I show this? So there can be situations where there is not even a discount. So that's where you have to be very careful. So that's why it's important to analyze it against the theoretical X-rights price and not against the current market price. Because this is the price that will be there after the rights issue. And the current market price is not relevant. Okay. After the rights issue, if no other new information comes out about the company, this is what the company is going to be worth. So this is what I should be analyzing my discount against to see whether it's worthwhile buying this company or not. So when I get a 30%, 40% discount, excuse me, I'll be very happy. But if the discount is 5%, 6%, although it looks like 10%, 20% discount when I look at it at current market price, if the actual discount is 5%, 10%, I might not want to apply for this rights issue. It might not be enough for me. So that's something that you should be aware of. So the easy way to do this without like looking and back calculating the number of shares, excuse me, the easy way to do this is to look at the fact that current market price is 560, right? This is for every 10 shares that the company has. This is worth, every 10 shares the company has is worth 560. Then you can subscribe for 3 new shares at 3 rupees each. So this is going to be the total market capitalization per 10 shares. And per 10 shares, now I'm going to have 13 new shares. And this will also give me 5 rupees. Without doing the complicated calculation, it will also give me 5 rupees. This is my theoretical X-rights price, which will give me that I have a discount of 40% that is being offered, and the discount of 40% to apply for a right at a discount of 40% is very decent. Okay. So that's the first calculation. So now the rights are trading in the market. Okay. The rights are trading in the market and you have the right to purchase these. Now, if I look at a timeline, usually something like this, how it would happen. There would be an announcement, just like you saw a commercial bank's case. There would be an announcement, right? Rights announcement. That's the announcement date. They would say, we're going to do a rights issue. Okay. And then they'll put out the date saying, okay, this is the X rights date. X rights date. What that means, X rights date, what that means is anybody who held the share before this day, is trading whom rights from the announcement date to the ex rights date. The share is trading whom rights. Okay. Whom means with. Whom means with rights. Anybody who buys the share from the ex rights day onwards, the share is trading ex rights. Okay. Meaning a separate right has now been allocated to the shareholder. So from the shareholder's angle, the shareholder on the ex rights date, he won't see it. You won't see it as a shareholder, right? But you are now the holder of the company's shares, and a right. Separate instruments, right? You will have two instruments with you from this point onwards. Before this point, you only had the company's shares. From the ex rights date onwards, there is a right that has been allocated to you. What is that right? The right to buy the share at a discounted price. Okay. And this right is an instrument. It is an instrument that has been allocated to you. Okay. So it is there in your CDS account. You won't see it, meaning that right creation will happen when the trading starts, but that right has been allocated to you. So now the share is trading without the right. Before the ex rights date, the share is trading with the right inside. Inside the share price, you have the share and the right. Okay. Inside the share price. Now you have two instruments with you. You have the share separately and you have the rights separately. Okay. The rights at the moment are, let's call it, silent instruments. You can't trade it, right? Only the share is seen in the market. So typically what you will see in the market is on the ex rights date, the share price will fall. So from 560 in my example, the share price will fall to 5 rupees on the ex rights date. It will not wait till the payment date. It will fall on the ex rights date. Okay. So from this point onwards, the share is trading without the right. So anything on the cum rights date, for me to do my calculations, I have to check the theoretical ex rights price. I have to calculate the theoretical ex rights price. Now, after the ex rights date, the share is anyway trading at the ex rights price. It's ex rights. It's not theoretical anymore. Okay. So you have my share that's trading at 5 rupees now. That's the ex rights price. And there is a right that is available separately. And then what will happen is the stock exchange and then the company will say, you have to pay for these rights. You have to pay the 3 rupees on this date. So that's called the payment date, right? This is the payment date. Just before the payment date, stock exchange opens up a small window of trading that says during this time period, until 1 day before the payment date, right? You have the ability to trade your rights. So if you want to sell your right to somebody else, or if you want to buy more rights from somebody else, you can buy or sell rights, not the share. Share is anyway trading in the market. But this right that has been allocated to you will now become a tradable instrument during this period. It will become a tradable instrument during this period. So the right can be traded. You can buy the right or sell the right until 1 day before the payment date. If you have sold the rights, you get money. If you have bought the rights, you have the shares, you have more rights. So you can pay for every right you have. You can buy the shares at 3 rupees each. For every right that you have, it gives you the ability, the right to buy additional shares at the price that has been provided. In commercial bank's case, 85 rupees. In this example's case, 3 rupees. Questions? Keeping this in mind, try the second part. When rights trading commences, what is the maximum price you should pay to buy a right? Don't take time. Don't worry about, unfortunately, I don't have the chat today. So some of you, I mean, a lot of the time, the first couple of answers might not be correct. So don't worry about it. We'll discuss it, okay? Don't take time though. Just let me know what your answers are. Correct. Good. 2 rupees. Others, do you understand why it's 2 rupees? Did y'all, some of y'all might have got as an answer. Okay. So these are some of the possible answers that I usually see, right? 560. 5, 3, 260, 2. Okay, so now you know that the correct answer is 2. But why is it not 560 or 5? Yeah? Not the share. Okay. So you're buying the right, not the share. So, correct. Exactly. Correct. Yeah. So that's a great answer. So you understand, I hope you all understand that if you pay 5 rupees 60 cents to buy the right, Okay, you are buying, like he was saying, you are buying the ability to buy a share at 3 rupees. You're buying a right, you're not buying the share. The share is trading separately. Okay, the share is trading separately, and the right is trading separately. So the share price, now you saw in my timeline that before the X rights date, the share was trading at 560. After the X rights date, with no other information, share should be trading at 5 rupees. Okay. And let's just assume the share keeps trading at 5 rupees. That's an assumption. Okay. Actual scenario will obviously be different. But the share is trading at 5 rupees. So in the market, the share is available for you to buy directly at 5 rupees. Now somebody is saying, but without buying the share, you can buy the rights. The rights are trading. Okay. Share is 5 rupees. The rights are trading at 4 rupees. Should you buy this? Should you buy it? Share is trading at 5 rupees. The right is trading in the market at 4 rupees. Should you buy it? The right gives you the ability to do what? To buy a share at 3 rupees. The right gives you the ability to buy a share at 3 rupees. So if I buy a right at 4 rupees, I have purchased the ability to buy the share at 3 rupees. I have not purchased the share. Okay. I have not purchased the share. I have purchased the ability to purchase the share at a discount. What is my total cost once I purchase the share also? 7 rupees. I can straight away buy the share in the market at 5 rupees. Share is trading in the market at 5 rupees. So why should I pay 7 rupees to buy this share? I should not be paying 4 rupees to buy this right. Because every time I buy a right, I have to then, what is my next step? I have to buy the share. I have to exercise the right and buy that share by paying a discounted price. Okay. So if I buy the right at 4 rupees and I exercise the right, then I have to pay an additional 3 rupees. So my total cost becomes 7 rupees. If I buy the right at 3 rupees, I still have to exercise the right, pay the share price, discounted share price. My total cost is 6 rupees. I can buy the share directly in the market at 5 rupees. That is why the maximum price I should pay to buy the share should be 2 rupees. It should be 2 rupees. Why? When I pay 2 rupees to buy the share, not the, sorry, let me rephrase that. The maximum price I should pay to buy the right is 2 rupees. Because when I pay 2 rupees to buy the right, I can then exercise the right, buy a share at 3 rupees. My total cost is going to be 5 rupees. I don't care if I buy the share straight away in the market at 5 rupees or if I buy the right here at 5 rupees. Okay. So that is why the maximum price I should pay is 2 rupees. If the right is trading in the market, if the right is trading in the market at 1 rupee, will you buy it? I wonder if I can do polls in this. This seems to have changed. The pole is also gone. Okay. Okay. So A stands for buy. Should I buy this? Right. A stands for buy and B stands for don't buy. A or B. A right is trading in the market at 1 rupee. Is it worthwhile for me to buy this right or not? Should I buy or not buy? You can see the poll, right? Can you all see the poll?
Yes. Yeah, I don't see anybody answering the poll. Sorry, what team again?
Say that again.
Sorry.
Wait, relaunch. Okay, I relaunched it. Try it now. Is this an attractive price to buy the rights or should you not buy the rights? Has anybody answered the poll? Because I'm not seeing any answers pop up.
We submitted the answer.
Yes, we submitted.
Submitted.
Yeah.
Something is really wrong. here. Unfortunately, I can't see anybody's answers. Something's really wrong with the Zoom today. So yeah, I can't see anybody's answers. I don't know what you all answered. What did you all say? Buy or don't buy? Buy. Okay. Yes. Because if you buy these rights at 1 rupee, you're buying the right to buy the share at 3 rupees. And once you exercise it, your total cost is going to be 4 rupees, which is much better than buying the share in the market directly at 5 rupees. So yes, it's a good decision to buy. The maximum price you will pay should be 2 rupees. Anything below 2 rupees is a good decision. Okay. So how do we calculate the maximum price that we should pay to buy the rights? We always look at what is either the theoretical X rights price or if you're evaluating it now, or the X rights price, because once it has gone X rights, that's the price that it's trading in the market is without the right. Okay. So you evaluate this against the, what do you call it? The price that you pay for the right, the discounted price. And this is the maximum price that you should be paying to buy the right. Any confusions here? Any questions? Okay. So let's quickly look at these are the different rights issues that are currently there. Okay. rights issue. UB Finance, Ceylon Hospitals, Hotel, Anilana, SoftLogic Holdings, Commercial Bank. So you can see here, these dates are to be notified, right? But if you look at Ceylon Hospitals and UB Finance, the dates are announced. So what are these? You can see UB Finance says that they are doing a 2 for 13 rights, 2 new shares for every 13 shares held. The EGM is essentially the date that you call the shareholders to get the rights issue approved. Right? If the shareholders approve it, next day it goes ex rights. So if you're offering shares to shareholders to buy, so you want to get shareholder approval. So the day before the ex rights date, you hold a EGM and you ask shareholders to approve the rights issue. If shareholders approve the rights issue, the next day the rights issue goes ex rights. So from the 14th of May, that's yesterday onwards, UB Finance rights issue was ex rights, right? 14th of May. So not yesterday, 14th of May, right? From last month. UB Finance was ex rights. Then your letter of allotment, you get a letter of allotment saying that you get a letter from the company saying that, okay, rights have been allocated to you. This is the amount of rights that you have been allocated. And the trading of rights commences from 30th of May to 6th of June. So the trading has now finished. From 30th of May to 6th of June, you could have traded your rights. And then after the renunciation, meaning 6th of June, you had to essentially say whether you're going to subscribe for the rights or not, or essentially, and then you make your payment on the 12th. Same way, Ceylon Hospitals, you can see trading of rights commenced on 3rd of June, right? Ex-right date was 15th of May. So within about roughly 2 to 3 weeks, rights trading will commence. Okay, 14th of May to 30th of May, 15th of May to 3rd of June, right? From the ex-rights date, usually in about 2 weeks or so, rights trading will commence, and that will be there for about a week or so. And from that point onwards, you either have to decide whether you're going to apply for the rights issue or not and make the payment. Okay. So this whole process will take announcement will happen before. You can see Commercial Bank has made the announcement, but not notified the rights dates. Once the dates are notified, the whole process will take about a month. Okay. So here it says UV Finance issue price is 0.6 to be utilized to comply with minimum capital requirements, regulatory requirements. Okay. And let's look at this example. So here, this is the old example because rights issue is trading right now. You're not seeing a lot of trading happening. So Pan Asia was not just Pan Asia. During this period, we saw a lot of different companies had a lot of trading happening on rights. Now you see 1 or 2 trades happening on rights, but you don't see a lot of trades happening on rights, right? So this example, I leave it as it is because I have a good graph where you see the rights prices trading. So Pan Asia did their rights issue in 2017. Okay? Did a rights issue in 2017. They might have done more later on. But this is the graph that I used, right? So the 2017 graph. So the rights issue, you can see the same way. 1:2 rights issue. Ex rights happened on 1st of February. And then trading commenced on 13th of February to the 20th. Okay. So you can see here, this is the prices of PABC rights. And this is the prices of PABC shares. Okay. So the rights trading commenced on 13th of February, 13th to the 20th. You can see it started trading at 150. On the 14th, it was trading at 90 cents. These are the closing prices. 70 cents, 80 cents, 70 cents, and it closed trading the last day 1 rupee 10 cents. Okay. And this is the price movement of Pan Asia shares. Pan Asia shares started on the 30th. So this is the extract date. So extract date is second. Second is here. Okay. Here. Second is there. So you can see here this sudden movement down. Okay. What is that? That is the price adjusting from the from the Kumrait's price to the X-Rights price. This movement down is the price going from the Kumrait's price to the X-Rights price. Now from this point onwards, this is the X-Rights date. So from the X-Rights date onwards, you have, this is from the second onwards. And before this date, it was Kumrait's. Okay. Now look, keep that in mind. And look at on 16th of February, that's on this date. Here it's here. On 16th of February, would you have preferred to purchase the share directly? Or would you have preferred to purchase the right? Why? Sorry, extra sale is 1st of February. My mistake. Yeah, that's why I was wondering why okay. Extra date is 1st of February. Yeah. That is not necessarily relevant for the sum. It's just that in my explanation, I was showing you a wrong place. So 1st of February was the extra date, and you can see that big drop comes because of the X rights adjustment from whom rights to X rights. You would prefer to buy the right because now you're looking at, you're on the 16th, right? You have to make that evaluation. You are today 16th. Today is 16th. And you're looking at the market and you're deciding whether to buy the share or whether to buy the right. You don't know what's going to happen to the share price going forward, nothing. Today is 16th. You're here. So imagine today is 16th of February, market is trading. Pan Asia price is how much? Share price is 15 rupees. Okay. So share is trading in the market at 15 rupees. And right is trading in the market at 80 cents. Now, this is your decision. Do you want to buy the right or do you want to buy the share directly?
You buy the right
Because
you can buy the right at 80 cents and then subscribe for the share at 14 and make a gain at the share price, market price of 50.
yes, your cost will be 1480, right? Your total cost. Today, your cost will be 80 cents. You will have to pay 80 cents today. And then on the 21st, you will have to pay 14 rupees to buy this right. So on the 16th, you will pay 80 cents. On the 21st, you will pay 14 rupees. So in total, your cost will be 1480 versus on the 16th, if you purchase the share, your cost will be 15 rupees. Okay. So you're better off buying the right today because it's cheaper for you than the share price, than buying the share. Because if you buy the right today, you can if you pay 80 cents today, you can buy the right at 14 rupees and it's cheaper for you than buying the share outright in the market at 15 rupees. So yes, would you have purchased the share or the right? You would purchase the right because it's cheaper. So that's how you make your evaluation. If you were here, cum rights, if you were in your cum rights, remember to do any calculation in this area, if you're like, if today is somewhere in this area, cum rights area, to do any calculation, you first have to bring the share price down to theoretical X rights price. But since you are here in this area, now the share is anyway trading at the X rights price. So you don't have to do any further adjustments to the share to compare it with whether to buy this or not. That's important to understand. So remember, one thing when you look at, for example, I was using the commercial bank example, you can't just look at the fact that commercial bank is 108 rupees now, and it's been offered at 85 rupees and say, okay, the discount is more than 15%. 100 to 85, 15% discount. No, it's not. Because you will get diluted. So you have to look at the discount after the dilution. Unless otherwise the share is already X rights, in which case the dilution has now taken place on the X rights date. Automatically, what will happen to the price? The price will adjust. The price will adjust to the X rights price, right? So the price, therefore, after the X rights date, you don't have to make, you don't have to do any theoretical calculations. You can straight away compare whether you want to buy the share or not. So these are things. And remember, when you buy rights, the other thing is, and now people are a little bit more educated, but this used to happen a lot, maybe now 10 years ago, right? 2000, again, that period I was talking about, I was explaining to you years back, 2010, 11, 12 period where the market was overheated and a lot of problems were going on because retail participation was high, but education was low. People were buying rights thinking that they are buying the share. So commercial bank rights, for example, trading at cheaper than the share. They were buying rights thinking that they were buying the share. And the problem in that scenario occurs when you buy the rights, right? Thinking that you're buying the share. But then you have to pump additional money if you want the share. So people found that they purchased rights and now they have to pump additional money to purchase the share, and they didn't have that additional money. And what happens with the right? The right disappears after the payment date. The right ceases to exist. The right gives you the ability to buy the share on a particular date at a discounted price. It's a call option. It's a call option. Okay. It gives you the right to buy a share at a discounted price on a particular day. It disappears after that day. That instrument no longer exists. So actually, there was a time during the 2010, 11, 12 period where you saw a lot of retail investors, right? Not a few, but many retail investors who didn't understand that they were trading in rights because the rights were trading and it was very attractive, and they were paying these high prices to buy it. Okay. And then they were figuring out that after that also you had to put more money. On the 13th, you pay 1.5 rupees to buy this share, to buy this right. And then on the 21st, you had to pay 14 rupees to buy the share. If you didn't pay 14 rupees and you purchase 1 million Pan Asia rights, because I have a 1.5 million with me, but I don't have 14 million with me, right? For every 1.5 million Pan Asia rights that I purchase, I have to pump in another 14 million to buy the share. And people found that they didn't have that money. And suddenly their 1.5 million just disappeared because that instrument ceased to exist. So it went from 1.5 rupees to 0 rupees. And you had no instrument, and you had no share, and you had no right. So that's what's important for you to understand. When you're buying rights, make sure you're either buying and selling and getting out of it before the renunciation date, or you had to pump in additional money to buy the share. Otherwise, you've lost everything that you've invested in. Any questions?
You buy the right in the market, it doesn't mean you have to buy the share, no?
Well, that's what I said. It doesn't mean you have to, but if you don't, I mean, it doesn't mean you have to. You can buy the right and you can find out that it's too high, but your money goes off, right? You don't recover any cent back.
And plus you actually paid out for the right.
Say that again.
Plus you actually paid out money for the rights.
You've paid
You
out
don't
money for
buy
the
it.
rights. If you don't
So
buy, it's a waste. Exactly. Because that entire amount of money is just spent on nothing. You've spent it on air, essentially. Right. But on a call option also, you do the same thing. You just have to do it with the understanding that you are taking a right, and you might not buy it at the end of the period. As long as you understood and did it, that's exactly what you do in a call option. But a lot of the time in these trading scenarios, what happened was people didn't understand that was what was happening. Okay. So, yeah. So we'll stop at this point for next week. Thanks.
Thank you.
Thank you.